Welcome to the Deep Dive. Today, we're tearing down the first quarter 2026 earnings call for Insteel Industries. They're a big player in steel and construction reinforcement.
Right. And our job is to figure out the central mystery here.
Exactly. Why does the company beat on profit, but the stock still takes a pretty significant hit the day of the release?
So we're going to get into the numbers, management's whole narrative, and probably most importantly, the big macro risks that are really telling the story here.
Okay, so let's set the stage. This call covered their first fiscal quarter, which ended late December 2025.
And that's key because Q1 is always their soft quarter. You've got winter weather, the holidays, construction just slows down.
So the real tension we're digging into is this push and pull, right? On one hand, you have some really impressive margin numbers.
But on the other, you have these persistent competitive risks and supply chain problems that are just looming over everything.
Let's hit the headline numbers right away because it was a classic mixed bag and the market reacted instantly. The stock dropped, what, over 4%?
Yeah, 4.31% close to close on the day. That tells you everything you need to know about the market's gut reaction. They saw risk.
So what were the numbers that drove that?
Well, on the surface, the profit side looked okay. GAAP EPS was 39 cents. The consensus was 38. So a small beat.
Beat's a beat.
True, but the revenue number is what stole the show. It came in at about $160 million when the street was looking for almost $162 million.
Okay, so a small miss on the top line. A 1.1% miss, to be exact.
Which doesn't sound like a lot, but in this sector right now, that top line trajectory is what everyone is watching.
And here's the crazy part. Even with that miss, their sales were still up over 23% compared to the same quarter last year.
A very robust 23.3%, yeah.
So that's the puzzle, right? Demand is clearly up, profitability beat estimates, so why is the market selling off?
Because the market looked right past that EPS number, it sniffed out how they got that beat, and it zeroed in on the things that threaten whether that growth is sustainable. We're talking cash flow and trade policy risk.
Okay, let's unpack the good news first then, the margin story. How did they manage to pull out a profit beat in their weakest quarter?
It was really a masterclass in pricing. Their gross margin expanded by 400 basis points year over year. That's a huge jump, up to 11.3%.
And that's all about the spread, right?
Right.
The gap between what they pay for raw steel and what they sell the finished product for.
Exactly. They were aggressive with pricing last year, and it paid off. It created these much wider spreads. But, and this is a really important technical point, sequentially so, compared to the last quarter, their margin actually got crushed.
It went down.
Way down by 480 basis points.
Why? What happened there?
It's all about inventory. They were finally using up the higher cost raw materials they bought months ago.
So the cost of goods sold was based on old expensive steel, even though they were selling at today's better prices.
Precisely. They said it was entirely due to the consumption of higher cost inventory. But that's what sets them up for a better Q2. Because they just put through new price increases in January. And since they use FIFO accounting first in, first out, they're about to start using newer, hopefully cheaper, raw steel while selling it at these new higher prices.
So the margin equation could flip pretty dramatically in their favor next quarter.
That's the bull case from management, yeah. And they also showed good discipline on the operating cost side.
The SG&A line.
Right. It went up a little bit, but as a percentage of sales, it actually dropped from 6.1% to 5.5%. That's operating leverage. You can see the synergies from those acquisitions they made in 2025 finally kicking in.
So disciplined pricing, good cost control. Which brings us back to the stock drop. It has to be the scary part of the story. The inventory.
It is the elephant in the warehouse, absolutely. Cash flow from operations, they used $700,000.
They burned cash.
Yes. Compare that to the same quarter last year when they generated $19 million in cash. It's a massive reversal.
And it was all inventory.
Almost entirely. Working capital was the drain, driven by a $34.5 million increase in inventories.
Wow. Why did they have to pile up so much? Was demand softer than they thought?
No, it was the opposite. It was a forced build. They had to load up on international wire rod because, and this is the core of the problem, domestic supply has just cratered.
Right. I saw that. We're talking about mill closures taking something like 1.2 million tons of domestic capacity offline.
A huge amount. So there's a real crisis in domestic supply. And this is where government policy makes a bad situation so much worse.
You're talking about the Section 232 tariffs.
Exactly. That 50% tariff on steel imports means U.S. wire rod prices are anywhere from 50 to 100% higher than the global price.
So let me get this straight. There's not enough supply in the U.S., so they're forced to import. But the imports are slapped with a giant tax, which makes everything incredibly expensive and forces them to buy in huge, inefficient quantities.
You got it. It inflates freight costs, it ties up cash. They said their working capital is up over $50 million in the last year because of this dynamic.
And management is promising a, quote, significant working capital release soon. But if domestic capacity is just gone permanently, isn't this the new normal? Are they just stuck importing forever?
That is the multi-million-dollar question, and that's the risk the market is pricing in. They're basically making a giant bet that they can manage this cycle until domestic supply somehow normalizes.
Okay, so let's pivot to that demand. If you're going to tie up $50 million cash, the sales better be there. What do they say is driving demand?
They pointed to two really strong multi-year tailwinds. First is infrastructure spending.
The IIJA money finally flowing.
Yep. They see projects funded by that act running through calendar 2027, maybe even longer. And second, and this is critical, is the data center construction boom.
That's a theme we're hearing everywhere.
And they see it staying robust right through 2026. Management literally called it a timely bridge that's getting them through while more traditional construction is a bit slower.
And they have a specific product that's perfect for that market too.
They do. They're engineered structural mesh, or ESM. The big value proposition there is speed of construction. Data center clients want to get online fast, and this product helps them do it.
So that lets them kind of sidestep the softer spots in the economy, like housing?
Exactly. They were clear that residential is only about 15% of their business, and even if it recovers, it won't have a meaningful impact on their 2026 results. Their fate is tied to infrastructure and data centers.
And they're putting their money where their mouth is, right? They committed to CapEx.
They did, up to $20 million for this fiscal year, split pretty evenly between basic maintenance and then projects to boost productivity and reduce their reliance on labor.
So for you, the listener, let's just quickly put their overall financial health in context.
Because that's the cushion that lets them take on this inventory risks. The balance sheet is rock solid. They have over $15 million in net cash.
And no debt.
Critically, zero debt. So the cash drain is painful, but it's not an existential threat. Not yet.
And they signaled that confidence by paying out that huge special dividend.
$1 per share. That's a big return of capital to shareholders. And it's the 9th special dividend they've done in the last 10 years.
But again, the biggest risk isn't on their balance sheet. It's in Washington, D.C.
It's the tariff policy uncertainty. That's the overhang. The constant threat that the administration could change or remove those Section 232 tariffs, maybe in a trade deal, that just creates total instability for their pricing model.
Okay, time for our segment, that is, and we must stress this, strictly hypothetical and for entertainment purposes only. This is not financial advice.
So we've laid out the core tension. You have fantastic operating performance and real structural demand from data centers and infrastructure.
Oh, it's fighting against this massive working capital problem that is completely driven by geopolitics and tariffs. The market sold the fear.
The manifest 4.31% drop.
Which leads us to our outrageous but plausible trade idea. We're calling it the contrarian inventory reversion play.
Okay, I'm listening.
The first party action is tactical. You short the stock right now.
So you're betting with the current market fear.
Exactly. You're betting that the market stays worried about the high-cost inventory they still have to burn through in Q2, and you're betting on the fear of some random tariff headline hitting the wire. You sell the uncertainty.
But you can't short it forever because that demand story is real. So what's the trigger to flip?
The trigger is the balance sheet. You go long, and you go long aggressively the moment you get confirmation that inventory levels are actually coming down.
So you're waiting for the Q2 report, for management to prove that significant working capital release is actually happening.
That's the tell. Once you see the cash drain reverse, you make the bet. You bet that the data center bridge is strong enough to carry them through, and you're essentially buying the multi-year demand story after the short-term policy mess starts to clear up.
Sell the geopolitical fear today, buy the operational recovery tomorrow.
That's the trade. You're betting on operations eventually winning out over policy.
So, to wrap it all up, The whole story this quarter was that internal discipline, the pricing, the great margins, running smack into an external wall of supply chain chaos and tariff policy.
Right. And that leaves you with the big question to think about.
Which is,
Amen.
if they pull it off, if they successfully use this data center boom as a bridge to 2027 and keep growing, will the market ever fully reward them? Or will this threat of tariff instability just keep a permanent lid on their valuation no matter how well they operate?
We hope this deep dive gave you the context you need to start figuring that out for yourself. Thanks for joining us.